The stock market has once again reached all-time highs. For many investors, this feels like the bull market is unstoppable because not even the threat of the tariff, recession fears, or geopolitical tensions could slow it down. But beneath the surface, cracks are beginning to show. News headlines are now flashing warning signs that valuations are stretched, bubbles are forming, and a crash may be coming soon. In this video, we will take a closer look at what's really driving markets higher and why the economy may not be telling the same story. Then, we will discuss what all this could mean for you as an investor, whether this is just another leg up in the rally or a calm before the storm. But before I start, do help to give this video a thumbs up. And in return, here's a cute quokka. So back in July, the labour market was reported to be stronger than expected, with job growth beating estimates. But that picture quickly changed in August, when the government suddenly revised the job numbers for May and June, down by more than 250,000 combined. That is bad news for the US economy, because fewer jobs means fewer people earning income, which in turn means lesser spending power. And since consumer spending makes up nearly 70% of the US economy, a slowdown in hiring can very easily tip the economy toward a slowdown or even a recession. Here, you can see that every time when the US unemployment rate goes up, recessions tend to follow. So even though July numbers were not as bad as the previous 2 months, these numbers may get revised down too. And this is just the beginning. With so much uncertainty caused by the tariffs, immigration policies, cuts to the federal workforce, remote work and automation, I won't be surprised if the labour market continues to soften over the coming few months. Speaking of the economy, did you know that you can use Momo AI to find out how the economy is doing now? Momo AI is built on Momo's extensive financial database and real-time market news, which means it is useful whether you are just starting out or already an advanced investor. You can ask Momo AI all kinds of investment questions, from understanding the US economy to summarizing long and boring financial reports, and even deep questions like what is the outlook for the US market tomorrow. And it doesn't just stop at Q&A. Momo AI also saves you more time in your daily investment routine. Just head to any stock page, scroll down a little, and you'll find daily and weekly briefs automatically summarized by Momo AI. That means you can get up to speed on key events and trading activity without having to dig through reports or spend time searching the internet. New users who sign up to Momo SG will get to earn up to $1,120 worth of welcome rewards when you fulfill the terms and conditions, which includes $20 worth of Nvidia share. Plus, enjoy zero commission for US, Hong Kong and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. For more details of the promotions, do refer to the link promotion page in the description below. Besides that, another thing that has been slowing down is personal spending, which has been going down since the beginning of the year. Now, even though there was an increase in personal spending in March 2025, much of it was due to the preemptive buying of goods before the tariffs kicked in before April. Because, no one wants to buy a $3,000 iPhone when they could just buy it for $1,000. Though, we now know that some of the deadlines for implementing some of these tariffs were extended then extended again, aka Trump always chickens out. But some tariffs have already been implemented, such as Mexico getting hit with a 25% tariff rate, Canada 35% tariff, and India 50%. What this would mean for the US is that it would cause the inflation to go up again. So even though the US inflation has not gone up yet, people are saying that it's because the stores are still working through their inventory before tariffs, and economists are expecting to finally see the effects of tariffs this summer. Lastly, consumer sentiment has also fallen sharply and is now nearing its lowest level in the past decade. The last time it was this low was in 2022, when inflation was surging and mass layoffs hit the job market. Now, that fear is returning. Consumers are bracing for higher inflation, a weaker job market, and the possibility that a Fed rate cut in September could reignite price pressures. This growing uncertainty is keeping households cautious, which could further slow economic growth. But despite all this bad news, the stock market is hitting all-time highs. Now, some people might say that it's because Trump always chickens out and the tariffs aren't here to stay. Or maybe the US companies are earning more money now, which helps to push the stock market up. But this doesn't explain a lot of things, because as you have seen earlier, the tariffs are here to stay. People are spending less, and even though companies are earning more now, if we look at the PE ratio of the S&P 500, it is now at 22 times earnings, above its 30-year average, one standard deviation, and is close to the peak in 2000 and 2022. Likewise, the Buffett indicator is now also showing signs of overvaluation. The Buffett indicators compares the total value of the stock market to the size of the overall economy, measured by GDP. In simple terms, if the market value grows much faster than the economy, it could suggest that stocks are becoming too expensive relative to the country's economic output. At the same time, the S&P 500 has also become extremely concentrated, with much of the S&P 500's returns coming from the Magnificent 7 stocks. If not for these 7 stocks, the performance of the S&P 500 would have been much lower. Now, before you be like panic, it's important to remember that some of these indicators are not perfect and may not necessarily predict a market crash. Take the PE ratio for instance. On its own, it doesn't account for earnings growth. For example, back in the 1990s, the average profit margin of the S&P 500 was around 6%. Today, thanks to technological advances and efficiency gains, that figure has more than doubled to about 13%. Similarly, the average earnings per share used to be around 30, but now it has climbed to over 200. In other words, companies are far more profitable today than they were 30 years ago, and their earnings are growing much faster. Likewise, the Buffett indicator also has its limitations in the modern economy. It compares the market value of US stocks against US GDP, but misses a big piece of the picture, which is globalization. In 1948, less than 5% of corporate profits came from overseas, but by 2024, that share has risen to almost 30%, and for the largest tech firms, it is even higher. For example, Apple now earns 64% of its revenue overseas, Microsoft 49%, Google 52%, and Nvidia 54%. This means comparing market cap strictly against the domestic GDP of the US tends to exaggerate valuations. That's why many analysts prefer the PEG ratio instead, which adjusts the PE ratio by factoring in earnings growth. If we use this metric, the valuations look less extreme. The PEG ratio today sits around 1.46, which is well below the overheated levels of past market peaks, like 2000, 2018, and 2020, when it ranged between 1.5 and above 2.0. But what about the Magnificent 7 stocks being too concentrated? Isn't that a cause for concern? Because even if one of these giant drops, it could significantly crash the entire market. The truth is, this concentration is not unusual. A study found that since 1926, just 4% of US companies were responsible for the net wealth creation in the entire market. In other words, markets have always been driven by a small handful of winners. Also, concentration isn't always bad news. Research shows that when market leadership narrows, it often coincides with higher returns, particularly when the leading companies are supported by strong earnings and fundamentals. And that is exactly what we are seeing today. The Magnificent 7 are not only dominating index performance, but they are also delivering stronger earnings growth than the rest of the S&P 500 combined. And that brings us to the question of, is it smart to invest at all-time highs? I think one of the common flaws of human behavior is to look for patterns, even when they don't exist. Many investors assume that just because the market has been rising for several years, a crash must be around the corner. But the truth is, history shows that all-time highs are not a warning sign of an imminent crash. In fact, they are often followed by even more highs. According to a report by JP Morgan, investing at all-time highs has historically delivered returns that are very similar and sometimes even better than investing on any other day. Over multiple time horizons, whether it is 3 months, 6 months, 12 months, and 24 months, forward returns following new market highs have been comparable, if not stronger than the average returns from any other entry points. Likewise, RBC Global Asset Management also found that investing at all-time highs rarely leads to steep losses. If anything, 1-year returns after investing at all-time high have remained close to the market average, and no 10-year period following an all-time high ever saw a 10% loss. Similarly, an analysis from Williams Asset Management shows that the average return after investing at an all-time high is about 13.4%, and over a 5-year span, it climbs to nearly 80%. The truth is that the stock market rises about 70% of the time, regardless of what's happening in the world, whether it's a recession, wars, inflation, or even a global pandemic. Most investors attempt to avoid the so-called bad years through market timing, but the reality is, when it comes to the stock market, Most of us are not as clever as we may think. Historically, more wealth have been lost trying to time the market than in the market's actual downturns. Sure, this time may be different. Economic cracks, geopolitical tensions, or unusually high valuations could create conditions for a correction. Yet, attempting to predict the exact turning point has rarely been profitable. Instead, a far more reliable approach is to stay invested, ride out volatility, and let the long-term power of compounding work in your favor. Even when markets reach record highs and headlines are filled with warnings, history often shows that disciplined, consistent investing remains the most effective path to wealth creation. By focusing on steady long-term investing rather than short-term timing, you position yourself to capture the market's growth and build wealth reliably, even amid uncertainty. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.